Hello and welcome to this weekly market recap. It's for the week ending Friday, August 23rd. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com. It's a pleasure to be with you all again this weekend. Kind of a crazy week for sure. It's not too often you get the Fed meeting at Jackson Hole. In fact, it happens once a year. So the Fed was out with was part of the economic symposium that's held in Jackson Hole, Wyoming each year. It's right around this time. Of course, two years ago, it was about this time that Fed Chief Powell said more pain ahead. If you remember, we had a huge run off the bottom of the S&P 500 from June 2022 up until August 26th, 2022. That was the day Fed Chief Powell came out of his hole. I kind of look at it a little bit like Puxatawny Phil seeing his shadow in Pennsylvania, whether or not we're going to have 6 more weeks of bad weather or not. Those on the East Coast, maybe some of you are in areas where you don't have to worry about this. But anyway, I look at it sometimes as, Jackson Hole J coming out of his Jackson Hole symposium and forecasting whether or not we're going to have 6 more weeks of bad market weather. Because typically the end of August throughout the month of September and then early October can be a very difficult period for the stock market, much like, February through, March can be really tough period for weather on the East Coast, Northeast. So anyway, with all that said and done, I do have to give Mr. Powell a little golf clap. He finally did it. How long have we been waiting for him to say that we're starting to change our tune and now we're going to start lowering interest rates? He basically said now is the time for a change in policy at the Fed. I mean, if that doesn't pretty much guarantee we're going to get a September rate cut, I don't know what does. So everything I was looking at on Friday was basically after that 10 o'clock meeting, taking a look to see what Wall Street was doing with that information, because for the first time, we got that confirmation. I mean, the Feds talked about it last month. They said it was on the table for the September meeting. A rate cut was on the table. Then we had the Fed minutes come out earlier this week saying that a rate cut was likely. First of all, the Fed minutes came from the meeting, and that's not exactly what Fed Chief Powell said. He said it was on the table. So I'm not sure how we get something that's on the table, which to me is maybe we're considering it kind of a thing. And then all of a sudden the minutes from the exact same meeting said that the rate cut's likely. So anyway, let's just not even talk about that, because now we have the Jackson Hole speech where Fed Chief Powell, or Jackson Hole J, depending on how you want to refer to him. Anyway, he came out and he said that we were looking at rate cuts starting in September, essentially. I mean, without actually saying that, when you say it's time for a change in policy, I think it's time probably to see those rate cuts. So I would certainly expect a rate cut. Now all the chatter is going to be, how big is the cut going to be? Is it going to be a quarter point? Is it going to be 50 basis points? Could it be bigger? I don't know. But at the same time he was giving that speech, we got the July new home sales out, and they blew away estimates. Not only did they blow away estimates for July, but June was revised a lot higher. So we got a really strong economic report. At the same time, the Fed basically is telling us interest rates are going to come down. I don't know, but I think that's nirvana for equities. And that's kind of the reaction that we got in the market on Friday, especially from small caps, which tripled the performance of the QQQ and the S&P 500. We're going to take a look at that in just a minute. But first, I'm going to start the charts off this week, and we got a lot of individual stock charts I'm going to show you this week, much more than normal. So if you like charts, like individual stock trades, you might like some of the charts I show you today. But I'm going to start off today with the 2002 chart of the S&P 500. And I pointed out here where the speech was and where Jackson Hole J poked his head out of that Jackson Hole symposium and said more pain ahead. Now, if you recall, back in June of 2022, that's where I thought we had a market bottom, and the market was taking off. We pulled back. We started to turn back up, and then the Jackson Hole J speech came out. He talked about more pain ahead. You can see The next 6 weeks, pretty bad market weather, moving back down to new lows, taking out that June low that I thought was the bottom, ended up calling for bottom 2.0 in late September of that year. And then in October with a CPI report, it was the September CPI report. We had a big gap down. It was a big number on the inflation, core inflation. And as a result, we had a big gap down, but that was it. So from there, we started to repair the chart. Of course, 2023 moved higher and the whole cyclical bear market was history. That's the way it played out in 2022. 2024, we got a little different story. Instead of being hawkish like he was in 2022, he actually has come out and now has turned what appears to be quite dovish. So we'll see how all this plays out. Let's see. Next chart I had for you. I wanted to go over the way everything evolved last week. Well, actually, this is intraday. So if you just look at what happened on Friday, and I show you 6 major indices, I show you 11 sectors. That's what's on this particular chart list here, and it just shows you what performs well versus what didn't perform so well. And right on the top, IWM, small caps gaining 3% on Friday, 3.19%. And of the 6 indices and the 11 sectors of the 17 groups in total, IWM was at least 1 percentage point above the other 16, including mid caps, which happened to be second at 2.18%. Consumer discretionary and technology on Friday still did okay, but as I'll show you on a chart, most of the technology gains were made from 9:30 to 10 in the morning. Didn't really have a whole lot of gains after the Jackson Hole J speech. So I'm going to show you a chart that shows you the intraday in just a minute. But I thought it was interesting to see small caps, mid caps on top, the defensive groups on the bottom. So this wasn't about defense, even though it wasn't growth and it wasn't necessarily technology after the 10 a.m. meeting. It also was not about defense. So it's that rotation, it's that shifting. If you recall, back in July, we got the June CPI report out. It came out on July 12th, 8:30 a.m. And from that point forward, we saw huge outperformance by small caps, remember? That was the day that the CPI report came in much lower than expected, and Wall Street said, that's it. We're getting rate cuts. They're coming. And so immediately, the shift went from the large caps to the small and mid caps. Yesterday, we saw pretty much the same thing when Fed Chief Powell came out and said, hey, we're switching. It's time to adjust our policy. This is it. I mean, it should have been like a little party. You should have had streamers going or something. I don't know. Been waiting a long time for the Fed to finally say that. But now their charade, all their drama, talking about, well, we might have to hike rates more because, inflation, we're going to watch inflation. Remember, got to be sustainable. I don't know what's more sustainable now than two weeks ago when we had the Fed meeting, when they probably should have cut before, or the meeting before that when I think they should have cut. But apparently they finally reached their sustainability. And so here we are with a Fed that's more dovish. So what do we do with all this information? Well, first, this is a 3-day, 10-minute chart. And I've got, actually, I'll go ahead and make this taller, much taller, so we kind of see these charts just a little clearer. All right, so let's start off with the IWM. So the IWM, this is where we were at, literally, this is the 10-minute bar. So this is where the day starts. This is 9:30 to 9:40. The next bar is 9:40 to 9:50. And the next bar is 9:50 to 10 a.m. So the close on this third bar is literally 10 a.m., right before the speech. And you can see the IWM, this is where we were sitting, 215 and change, under 215 and a half, and we finished over 220. So that's probably what, 2.5 percentage points that we ran up after Jackson Hole J started his speech. Now you go down the spider where we were, probably looking at the numbers here. Let's see if we can just zero in a little bit more there. We were down at about just under 560, and we went up to about 562. So what did we go up? Maybe 0.5%? Not even that, probably. So remember, here we talked about 2.5% higher on the IWM. Maybe 0.5% on the S&P after the speech. Then we've got QQQ. Look at where the QQQ went from. Basically right here at 479, and it ended at 480. That was $1 up on the QQQ, which was, probably between 0.2% and 0.25%. So really almost unchanged, a little bit of a gain throughout the balance of the day. Pales in comparison to that IWM, 2.5% gain. So I don't know if we're going to get this wide divergence in performance like we saw after the July CPI came out. It was the June CPI came out on July 12th. Remember, the first 2 weeks after that report came out, we had an 18 percentage point gap between the IWM and the QQQ, and then started giving it back after that when the market topped. And then, of course, the Fed, in my opinion, laid an egg. They had an opportunity, didn't do it back at the Fed meeting. And as a result, we had the big gap down on Monday morning. Remember that, August 5th? Well, all of that now has changed. And with the Jackson Hole J speech, now we've got things moving back up again. And we saw it once again moving toward the small caps. Is it going to happen again over the next couple weeks, couple months, 6 months? I don't know. We're going to find out. But I can tell you, small caps like it when the rates come down. So we'll see where we go from here. Moving on. So here's the mid caps. Look at the mid caps going from what, 558 right here, under 558 to 566. That was probably about 1.5% move. So the real push after the Jackson Hole J speech was in small caps and mid caps. So even though when we look back at this table and we say, okay, IWM did a little bit better than the XLY and, a little bit better than the XLK. Remember, most of the XLK's gains were prior to 10 a.m. Once the speech started, only, what was it? Well, the QQQ, not technology, but the QQQ, which is 50% represented by technology, only went up it was up less than 0.25%. Balance of the day. So I do like to follow these relationships closely when we get news, important news. So Fed meeting certainly qualifies for that. Jobs report, those types of things. What is Wall Street doing with that information? This is how you tell. I mean, at the end of the day, again, you just look at your account and you say, oh, I'm in the QQQ. I had a good day. Not really telling you the whole story of what took place in the market. Moving on, IYT. Look at transports making the big move. Probably 1.5% after that 10 a.m. meeting. Lower interest rates down the road, probably going to spur the economy. What happens when the economy is spurred? More goods get shipped. There's your transportation. That's why you see transports moving up. Now, here's an interesting thing, though, and this is why I look underneath the surface of the market. The IWF IWD, this is large cap growth versus large cap value. It was up in the morning until 10 a.m. And then look almost immediately at when the speech was going on, look at the drop in growth stocks versus value stocks. So as I said, defensive stocks didn't really shine. And we know after 10 o'clock, it wasn't technology. So what was shining? Well, you can see discretionary versus staples. That's a good thing. When the market goes up and you get that XLY, XLP ratio, that's one of my favorite, if not my favorite, sustainability ratio. I love to see that move up when we get, new news. So obviously the market is favoring discretionary versus staples, which is good. Look at, here's the XLK. So there was your XLK, already up quite a bit to 10 a.m. And then we went up, what is that? Maybe a third of 1%, something like that. Financials went up probably about 0.6%. But look at the jump in industrials. And part of that was because of transportation. But industrials down at about the 128.20. Well, we closed probably 128.30 and we're finished at 129.30. So that was probably about 0.8%. So you can kind of see money is kind of shifting small cap, mid cap, some of the more aggressive well, it's kind of like, opposites a little bit. Financials and industrials, I consider to be aggressive areas, but they're more value oriented, aggressive areas, if that makes any sense. You got a lot more dividend payers. I mean, financials, think banks and so forth. A lot of the industrials, think about, Caterpillar, Deere. I mean, these are companies that pay dividends as well. And they're much more cyclical in nature. So when the economy strengthens, they tend to do much better. And so if you think that the economy is going to strengthen, you want to start moving into industrials and financials. Now, they're not the ones that typically blow away the S&P 500, though. That's where the growth comes in. That's where XLK, XLC, and to some degree XLY come in, because they're more aggressive and they tend to do better and they tend to do well when growth leads value. But what I was seeing on Friday was a little bit of a change, which I think is good. I think that we've kind of been lacking wide participation over the last couple of years. We've talked about Mag 7 and everyone said that was a bad thing. Well, it's not a bad thing if you're in the major indices or if you're in those stocks. But I understand a lot of other companies certainly were not performing at that level. And so the advance was pretty narrow. This is the opportunity for this secular bull market to expand and become very, very wide, with the bull market lifting all boats, not just the Mag 7 boats or the Mag 7 boats lifting the major indices. So we'll see what happens from here, but at least the initial reaction is exactly what I would have expected from Wall Street, which was more money rotating into small and mid-sized companies and more into value versus growth. All right, I'm going to start showing you a bunch of charts here, some areas that I thought looked kind of interesting from Friday or from recent action, and then we'll talk about a couple individual stocks in these areas that maybe we can take advantage of. By the way, on Monday at 5:30 p.m., we have our portfolio draft. We delayed it. I mean, it's very difficult to have the draft right before we had this Fed well, not a Fed announcement, but Jackson Hole J, his speech. We saw what happened in 2022, where we absolutely just cratered. And so going in, the question was, into this draft, my question is, how much growth do you want versus how much value? How much offense versus how much defense? And I think Jay helped answer some of those questions. So on Monday, I'll be talking about all the themes in the market and why we're going to go the route we're going. But we're going to have 10 equal weighted stocks in our model, aggressive, and income portfolios, 10 equal weighted stocks in each of those three. And it's available to any member at Earnings Beats, even trial members. So if you go over to Earnings Beats, sign up for a 30-day trial, come into this portfolio draft on Monday. I think you're going to find it very enlightening. And again, we'll talk about where we see the market going and the areas of the market that we want to be represented by and the individual stocks that we're going to pick as a result. So go to earningsbeats.com. I'll show you the website toward the end of the show so that you can come over, subscribe. Also, if you want, just sign up for our free EB Digest newsletter, which is published Mondays and Wednesdays. Going to have a really good chart for you on Monday, and I'll just leave it at that. So within renewable energy, here's in renewable energy. I liked seeing it get back up above the 50-day. It's got a little bit of work to do. We got a couple of tops, one up near 450, the other just below 440, which is kind of where we finished on Friday. So we're testing this area. We have gap resistance comes in just a little bit below 440. Monday could be a big day if we can see the renewable energy group move back through that key level. This is a group that when it moves, and you can see just back in May what happens when this stock move or when this group moves. A lot of that, by the way, I think was First Solar, because First Solar does make up a big part of this index. But all the stocks in this group really tend to move fast. They're very similar to the semiconductors. I would say they're not as consistent as the semiconductors, but when they get rolling, they look like the semiconductors, where you could see 100% advance in a couple months, 2, 3, 4 months. So I'm watching this group because we get that breakout. You could see some key areas or not key areas, but key stocks within this space. First off would be First Solar. You can see this chart looks very similar to the renewable energy chart I just showed you because it is such a huge part. But watch that breakout. If we can get through on First Solar around 235, 240, that could open up a quick move up, maybe to challenge the high from back in June. A couple of others. One that I really liked on the move Friday was Enphase. So Enphase has been kind of moving up. The volume had been light. Wasn't exactly heavy volume, but the volume did pick up on Friday, and we closed at about a 2-month high on Enphase. This is a stock that's got, again, huge long-term track record. If we go back and we look at a 5-year weekly chart, remember in 2020 and 2021, that's when the small caps took off. You know what else happened? Interest rates fell considerably. That's when we saw small caps explode. It's also when we saw Enphase Energy explode. Since then, we went sideways and we've been drifting lower, kind of similar to what small caps, mid caps have been doing, right? Now, all of a sudden, we got small caps and mid caps starting to show some strength. Watch stocks like Enphase Energy. These are stocks that make that breakout. They could have a huge, huge run up to the upside. So that's certainly one I'm watching. Also, a stock that broke out, Run. This is a company that's heavily shorted as well. It broke out. I'd like to see more volume coming in, but taking a look back, you can see 52-week high on Friday, closing up near the high of the day, and volume, while it wasn't huge, definitely picked up from what we've seen over the past week or two. Moving on, how about those small cap, mid-size regional banks? These are areas of the market that I think we've got to pay close attention to. Small caps. When I started the year back at Market Vision 2024, back in early January, I said I thought this could be a great year for the banks. I thought it could be a great year for small caps. Of course, when I was talking about it back then, I was expecting that by the second quarter, we'd be seeing lower interest rates. They were delayed. So as a result, some of the action in the banks was delayed as well. We had a really strong end of the year, but then beginning of 2024, mostly just sideways. We just went sideways for a while. And then in July, what happened? We got that June CPI report out, remember? And everybody started saying, okay, the rate cuts are coming. And as soon as the market focused on that, we saw the KRE soar. And then what happened? Once again, it was Jackson Hole J. Of course, this was before Jackson Hole. So this was just Fed Chief Powell, in my opinion, dropping the ball on an opportunity to cut rates, which would have extended, I believe, the move up in the KRE. Anyhow, we drifted lower, just kind of went sideways, started moving back up. And then with Jackson Hole J's speech, look at what happened. We got a huge move up in the KRE. I really like this area as we go into rate cuts. This is going to help the small banks. The small banks are much different than these large banks. Large banks, they make a lot of money from trading and a lot of other activities that small banks don't. And so your JP Morgans and Bank of America and Wells Fargo and Citigroup and PNC and all these big banks that did really well and have been able to do really well while the market's been bouncing back and everything. Small banks, they didn't have that luxury. They needed to see rates coming down. The inverted yield curve has really hurt banks, small banks, and the small company customers that they have. And so part of why the IWM has been struggling. So I think when we start lowering rates and we get that inverted yield curve to uninvert, I think that's going to be a really big bullish development for small cap stocks. And that's what I think we're starting to anticipate. That's what we saw in July, and that's, again, what we saw on Friday. How about a couple of stocks in this space? Well, and these are a couple of component stocks of the KRE, a couple of the largest holdings. One is Western Alliance Bancorp. Look at the move on Friday. We haven't broken out. We didn't break out the KRE yet. See that? Not quite up there. WAL made the breakout, closing high. And then the other one I had for you was VLY. This is another one, one of the top components. This stock, not anywhere near its high, but it has been going sideways for a while, really struggling between about 8.25 and maybe 8.50, a little bit above that. Closed up near 9, and you can see the volume pick up. This is a smaller bank, clearly in price as well. But that breakout, I think we could see an additional run, maybe up to that 1075 area to challenge the December 2023 highs, and then we'll see what happens from there. But just getting up to there would be, almost 20% move to the upside, maybe a little bit more than that. Let's not forget, though, there were some other financials last week. Look at JP Morgan. Now, this is one of the largest banks. Look at this breakout. Yeah, we had that weakness at the end of July, early August, come right back out of it. We snapped out of it, back to new highs. So there's one. How about Goldman Sachs? Goldman Sachs in the investment services area, moving up, 510 level, challenging that end of July high. Then we had Bank of New York Mellon, BK, making a breakout. This was a really good earnings report we saw back in July, pulled back into gap support zone, and now it's broken back out again. Really nice looking chart there. All right, moving on. Transports. Transports went down, tested that 14.8 area. I mean, we went from 16.3 to 14.8 in 3 trading days. Think about that. That's a big drop. It's like almost 10% of transport's value dropped in 3 trading days to go all the way back down and test the low after the disappointment from the Fed. But we come rallying back. We get that Jackson Hole speech, and look at the transportation index moving back up. Now, clearly, we've had many tops from about 16.2 to 16.3. We want to get through that. But if we do, that could really set up for a strong end-of-year rally in transportation stocks. A stock that seems to be coming to life here is FedEx. After the big gap up we saw at the end of June with earnings, we continued to move up, pulled back into this big, wide gap support zone, and now we're starting to make this run back to the upside. And the interesting part, I always like to follow FDX versus UPS to see which of the two. Well, there's not even any doubt at this point. FDX, FedEx, completely annihilating United Parcel Service. And if we go back, you kind of have trends and ebbs and flows in these two. But look at the 5-year chart. We saw, throughout 2021 and 2022, we saw UPS leading. This is FDX dropping. Since the beginning of 2023, FedEx has been the place to be, not UPS. All right, a couple of other stocks I wanted to show you here. Let's talk about JBHT. Been beaten up, had a big gap down in April, rallied back in July to get back around 176 or so, pulled back, and yesterday closed back at the high since that gap down. So I think it's got a good chance to run up to fill this gap now, which is probably around 182, 182 and a half. That's maybe another $5. If it gets through that, could be a strong finish to the end of the year for JB Hunt. We got NSC, which is Norfolk Southern, a railroad. I love that move that we saw back at the end of July. Earnings related, we've pulled back. We're in this sideways consolidation. Interesting thing, if we annotate this chart, so if I kind of come in here and just kind of highlight or connect these lows, you can see we're sitting right on this uptrend line. But since topping, we're kind of squeezing on this downtrend line. Which way is this going to break? I'm not really sure, but my guess is to the upside. So this is a stock, maybe the railroads as a group, kind of keep an eye on them. But again, if you're going to look at maybe a strong economy down the road and transports are going to go up, that's why I would kind of lean toward this breaking out to the upside and moving to new highs. Ryder made a breakout. Ryder rents trucks. Here we go. 140 was the high from back at the end of July. made that breakout on Friday. I'd like to see a little bit more volume. Volume was just kind of so-so, but the price breakout was made. Let's see if we can continue that early next week. All right, moving on. How about semiconductors? Well, semiconductors last week were just kind of flat, but after the big down day on Thursday, it was actually a little bit of welcome relief to see the move back up. I was fearing maybe another big gap down and perhaps a huge drop. That didn't happen. So even though growth wasn't exactly in favor on Friday, you can see that semiconductors gapped up and they did actually finish higher. Now, if we look from the time of the speech, which was at 10 o'clock, so we were about right here, we initially made a big pop, then we kind of fell apart. A lot of volatility. We ended on a pretty good note and above where we were when Fed Chief Powell finished his speech, or Jackson Hole J, I should say. So it was a good day, I think, for semiconductors. Not a great day, but it also could have been a lot worse given the fact that growth stocks didn't do well. I thought semiconductors held their own pretty well. Looking at some stocks in this space, well, I got to start with NVIDIA. NVIDIA reports its earnings. Not sure why that came up, but okay. NVIDIA reports its earnings this Wednesday after the close. Really hard to say. I mean, I wouldn't want to bet against NVIDIA, but my bigger question is not going to be, well, obviously one question is, do they beat, which I think they will. My bigger question is, what happens to NVIDIA? Does it gap up above that 140 level and get a breakout with earnings? Or does it get good earnings, but it gaps up below the 140 level and then continues to consolidate? Because obviously I'm fearful of a bigger drop, but I'm also fearful of a good report not being able to break out. And that could lead to much more sideways consolidation in which NVIDIA may have to wait a few months, perhaps, to see another high. That's going to be probably one of the biggest deals going forward next week, is what happens to NVIDIA after its earnings report on Wednesday. All right, MPWR. If you want a large cap semi name that's looking good, this is probably one of the best ones. Made the breakout. If anything's lacking, it might be a little volume. I'd like to see a little more volume coming on this push to the upside. But hey, price is price. Not very many other semiconductors are doing what MPWR is doing, which is breaking out to new highs. So definitely worth watching. A more value-oriented semiconductor is something like Texas Instruments. Look at Texas Instruments making a breakout. So you can still be part of the semiconductors, but maybe just shift over to something that's a little bit more value-oriented, that doesn't run crazy with all of the other semiconductors when we get on these runs, but still has a great long-term track record, pays a dividend, and appears to be liking what's going on with interest rates. So Texas Instruments looks like a nice breakout there. How about a couple of mid caps? How about Cirrus Logic, CRUS, making a breakout? This is within the semis. Semis haven't made a breakout yet, so these are clearly leaders within that industry group. IDCC, this is InterDigital, with that earnings report and the gap up. I think anything, if it pulls back to around 130, maybe slightly below, I think IDCC would be an interesting play in that semi space. All right, let's take a look at the furnishings. So furnishings, when you look back, I'm going to pull up a longer term weekly chart. Look at all of these tops coming in near the 400 level. So this was back in January of 2023. Then we make this run up into March of 2024. Then we just recently in July, when we had that CPI news, this was one of the areas that took off. Why? Well, when rates come down, home building goes up. So furnishing is kind of an ancillary piece here, also moving up with it. Then it kind of pulled back with everything else, especially the areas that were, moving up with that solid CPI report. Those stocks moved back quite a bit into late July, first week of August. Look what happened yesterday when we got that big news from Jackson Hole J, that, hey, they're changing their policy, making a move. A run through 400 would be bullish for this group. And so at that point, you'd want to at least be aware of maybe some stocks that could benefit from that. How about MHK? All right, I'm not sure why this keeps coming up. Keep switching me over. I like the classic. I'm a kind of a routine kind of guy. Little OCD. I like to keep the same charts. I like just doing things the same thing. I go to Starbucks every morning. I sit at the same table. I order the same drink. I don't know. I just don't like changes. So I'm still liking the classic sharp charts. But anyhow, look at MHK after gapping up with earnings, pulling back into gap support, holding the 20-day, starting to turn back up. If the group breaks out, I would look for MHK to be a leader. VIRC, we're going to talk about a couple small caps here. Just made the breakout. Volume is not great, though. I mean, this was a decent volume day, and it was only 309,000. So this is the type of stock I would not put in our portfolios because, if we have a number of members who decide to get in, I don't think it's liquid enough for a number of people to be buying. I would still consider it on my own as an individual trader. I think it trades enough volume where you can trade it, just not for the portfolios. So anyway, VIRC making a breakout already with volume pretty maybe moderate to slightly above normal. How about Tile making the breakout? Big move here on Friday. Volume picked up, had kind of a triple top up around the 18 level, took that out. Beautiful move. I mean, I would certainly expect this is going to move higher. Could it pull back, a little profit taking first? Sure, it's possible. I really like this stock, though, on a 20-day test. And the last one, well, actually, I'll give you a couple more, but one I'm going to give you in this furnishing space, and I'm going to call it my sleeper, no pun intended, Sleep Number. SNBR. Now you look at this chart and you say, what is redeeming about this chart? Well, a couple of things. Number one, since that CPI report came out, look at Sleep Number trending higher the whole time, even with the pullback that we saw in August among the major indices. This stock actually did very well on the day that, I think this was the day after the Fed announced. I think the Fed announced on the 31st of July. Which was a Wednesday. And then Thursday, August 1st, we actually saw Sleep Number have a huge day to the upside on big volume. So it's starting to show a little bit of resilience. Pulled back, it held that 20-day moving average, which is always a good sign. 20's now crossed above the 50. We got a golden cross. And this breakout, we did actually close slightly above that early August high with volume starting to pick back up again. So that kind of has me interested. Also, remember when the rates were down back in the 2020 to early 2021, right after we dropped, as a result of the pandemic, rates went down and we saw small caps explode. Look at Sleep Number. Sleep Number went from probably $15 a share to $150 within a year, 10 times. And then this whole period while small caps have been struggling, this has been an underperformer. I mean, this isn't just struggling. It's gone from 150 down below $10. So it gave all that back, gave it away. But it's starting to strengthen again. And if rates are lower and the economy begins to strengthen, down the road, I mean, even 4, 6, 9 months from now, we could start to see a even stronger consumer with inflation in check, rates low. And that could really spur companies like Sleep Number, I think. So this might be a little early. Maybe it's a little premature, but you can look back and you can see and count on one hand the number of weeks that we closed above the 50-week moving average on Sleep Number. Last week, the 50-week 1417, we closed at 1435. So you can see we actually had a slight close above the 50-week moving average. And the way I count it, there have only been, since 2021, 3 weeks where we have closed the week out above the 50-day moving average prior to this last week. So this is the fourth time in 3.5 years that we've seen Sleep Number close out a week above its 50-day. And in this case, for the first time during this period, it's when rates are now about to drop. So I'm calling this one my sleeper number corporation, SNBR. Got kind of a little bit like a triple bottom down here. A breakout above about $18 would really be big. And that you can see on this chart, on the daily chart, were these tops right in here after the gap down in November of last year. These reaction highs went right up, never could close above 18. This stock closes above 18. Getting to 18 would already be a nice move. But if we close above 18, that would be really bullish. All right, just a couple more charts here. One that I really like, I love this move on Zoom last week. Big earnings report. They beat on top line, they beat on bottom line, which isn't much different than what they've been doing in the past. But they also did raise guidance, which I thought was good. The market reaction, look at the volume on that huge candle right there. I'm not saying this goes straight up from here, but I believe that this stock is reversing and beginning to make a push up. Watch $75 more recently, like over the last year or so. We've gotten up to 75, haven't been able to get through. We closed just over 70 on Friday. This is one to kind of keep an eye on. Another one, if you go back and you look at a 5-year weekly chart, again, when the rates were low and we had to stay at home and all of that going on, that's when Zoom made that huge run. It's been going down now. It's been sideways consolidating. And I would challenge you to find a better looking week than Zoom had last week. I mean, going back the last couple, 2-3 years, there are very few weeks that compare to what this stock did last week and on this kind of volume. So I like Zoom. I think it's kind of turning the corner, and a move through 75 would be really bullish there. The other thing to consider, a lot of the most heavily shorted stocks are small cap stocks. So if small caps start seeing rotation, it just kind of makes sense that maybe some of the smaller stocks that are on our short squeeze chart list may come to life. And I'm watching these stocks closely. This is one that made the move. What I look for, I set up my chart style completely different with a short squeeze candidate. One of the most important things to me is volume. So what I've done is I've created volume as a separate indicator. So down below, here's where you can have volume and you just put it overlay or separate, so it's below the chart or it overlays over the price chart. I turn that off. Down here under indicators, you can put in volume right here. And here I positioned it above the price chart. And I put a simple moving average in and overlay the 50-day simple moving average of volume. That's how you can set up volume the way I did. And you could leave it at the bottom simply by saying below instead of above the price chart. But I like this because I can quickly visualize to see if the volume is more than average volume or not. Now, this one is slowed down, but clearly on this move to the upside, that was a short squeeze. There were a lot of folks shorting this stock that got caught, and somebody screamed fire in the theater, and all the shorts are running for the exit all at the same time. And so that's the kind of move you can see with short squeeze stocks. This thing went from 8 to 40. It went up 5 times in 2 weeks. That's what some of these others could do. So make sure when you go to Earnings Beats and you sign up for the 30-day trial to join me on Monday, check out the short squeeze chart list that we have as well. You could maybe find some really big winners coming up here over the next couple weeks to a few months. If small caps continue to get that money rotating, really watch these small caps or these heavily shorted stocks. All right, that is about it for me this week. I really want to spend some time going over some areas that I think look interesting, go through some stocks in those areas. So it's a little bit different take on the weekly recap, not as much education and intermarket relationships and that sort of thing, focusing more on the actual price action with Jackson Hole Jay's speech, and also looking at some individual stocks as well. But anyway, go over to earningsbeats.com. Here's where you can sign up for your 30-day free trial. There is a credit card required, but we won't charge you until the end of the period, and we'll send you an email to remind you that your trial is coming to an end and you're going to be charged. So it's not like you're going to set up and you're going to forget about it. We're going to make sure you know. We only want members who want to be with us, that want to pay us for our services. But check that out. And at the very least, scroll down and sign up for our free EB Digest. Got a surprise, really good chart for you on Monday. One I think will do particularly well as we head toward year end. So be sure to sign up at least for that free EB Digest newsletter. This, by the way, does not require a credit card. You can unsubscribe at any time. That's free to our community, just trying to give back there a little bit. Anyway, that's it for me. I appreciate everybody tuning in. Enjoy the rest of your weekend, and we'll get back at it on Monday. Happy trading, everyone.